Good day, everyone. I think we can get started now. I'd like to welcome you to this IAA webinar on ERM Insights from Failures and Near Failures, a chapter from the IAA Risk Book. I'd like to start by introducing the speakers that we're going to have today. My name's Kathy Wong. I'm going to be your moderator for this session. I'm a fellow of the U.S. Society of Actuaries and a CERA, Chartered Enterprise Risk Analyst. I'm pretty much retired from corporate actuarial work, but I continue to be very involved with the Society of Actuaries and the IAA in the areas of enterprise risk management, education, and professionalism. We have three panelists who are going to be joining us today in our talk, who have all had experience with insurance organizations that have failed, at least partly due to what could be considered ERM issues. I'm going to introduce all of them now before we get started so we don't interrupt the flow of the talk. First up, we will have Tony Coleman, who's a fellow of the Institute of Australian Actuaries, also a CERA. And Tony has served as a chairman, director, advisor, and senior executive across a wide range of leading Australian and international organizations. He has extensive experience in governance, insurance, finance, investment, risk management, and climate change. Tony's a past president of the Actuaries Institute of Australia, and he's had various leadership roles in the International Actuarial Association, including serving as a previous chair of the Enterprise and Financial Risk Committee. Next, we have Masatoshi Ito, who's a fellow of the Institute of Actuaries of Japan and has more than 30 years experience in the life insurance actuarial finance field as a product executive. He started his career at Toho Life and later extended his career into the area of risk management. And currently he is the appointed actuary at Prudential Vietnam Assurance. And then finally, we have Stuart Wason, who has more than 40 years of experience in actuarial, insurer consulting, supervisory management. He's currently serving as a member of the IAA's Pandemic Task Force and on the Risk Book editorial board. In recent years, he served as a member of the IAA's Climate Risk Task Force and as chair of the IAA's Insurance Regulation Committee. Stuart is a former senior director in Canada's Office of the Superintendent of Financial Institutions, OSFI, from 2007 to 2016. Okay, a couple housekeeping items before we get started. For those who are attending, your speaking capabilities have been turned off. We would like you to submit your questions or comments by clicking on the Q&A icon, which should be at the bottom of your screen. And we will do our best to answer questions during the Q&A session at the end of the panel discussion. Secondly, this session is being recorded. We know that everybody's in different time zones, so some of you may well be watching this as a recording. It should be available on the IAA website within the next day or so following this session. A couple of disclaimers that we need to make. Some of the speakers are members or former members of various IAA committees or forums. All of the remarks made today are the speaker's personal opinions. They are not and should not be construed as official positions of the IAA, any of its forums or committees, or of their current or former employers. Okay, so getting that out of the way, to set the stage for the discussion, I'll give just a little bit of background. The Enterprise and Financial Risk Forum of the IAA exists to facilitate knowledge sharing among IAA member associations, and we focus on issues of international relevance for actuaries in the area of enterprise financial and investment risks. The EFRF, which at that time was a committee, began this project back in 2017 to start to monitor research on failures of insurance organizations. And this work eventually evolved into a risk book chapter on insights from ERM failures and near failures. and that was published in March of last year. We did do a webinar in December of 2023 covering some of the general lessons learned on ERM failures, and we highlighted 3 case studies from the chapter. So this webinar is going to follow up with some additional case studies and then a bit of a broader ERM discussion. Okay, we can go to the next one. The structure of the webinar is going to be starting with a moderated discussion of ERM failure and near failure cases. Each of the 3 panelists has good knowledge of a particular situation that has occurred, and we're going to let them talk about that. Then we'll move to more of a roundtable discussion of the ERM environment and particularly how it has evolved. And as we're doing that, we will look at the audience questions, and to the extent that time permits, we will try to bring those up. We're including some questions that actually arose in the prior webinar that we were not able to get to, so that has been structured into our talk as well. Okay. So we are going to start with Tony, and Tony is going to focus on HIH in Australia. And Tony, I'd ask you to start with a short description of what the issue was at HIH.
Thank you, Kathy. Just to give a little bit of context for everybody, HIH was a very large non-life insurance company, predominantly operating in Australia and New Zealand, although they did have a couple of subsidiaries in other countries around the world. And it collapsed financially in March 2001, which I still remember quite vividly. The most simple explanation, I guess, for why it collapsed was that there was some very serious under-reserving of its insurance liabilities, particularly for long-tail classes of business. It had reached the point where it had consistently quoted very low premiums for long-tail classes for a long time, particularly workers' compensation, public liability, disability insurance type covers. And because it was quoting very low premiums compared to what anyone else was prepared to quote, it became the dominant provider of such cover in Australia in particular, because other insurers simply weren't matching its prices. And so we've obviously had a serious actuarial problem, but we also had a very serious problem with board governance, which I can talk a bit more about as we go on.
Yeah, so maybe you can get into what was the primary factor that you think led to their problems.
Well, it was the under-reserving. Just to put it in context, it remains even now, this was back in 2001 when it collapsed, it remains now the largest liquidation of any corporation ever in Australia, even now. It was about liabilities exceeding assets, about 5 billion Australian dollars. That was actually a bit more than that, so roughly 4 billion US billion, sorry. There were a whole range of factors. There was a sole practitioner actuary who was providing their advice. In many cases, the rather dominant CEO at the time was able to downplay the importance of that advice, and he was appointing board directors who were supposed to be considering that advice, who were very much in his pocket, shall we say, and who really didn't understand the significance of what the advice being provided was. It raised a whole series of issues, and just to put it in context, 3 senior executives, including the chief executive of the company and the chief executive of the company they took over shortly before they went bankrupt, all served time in jail in Australia, more than 5 years each. And there was a royal commission into what went wrong. I found myself at the time as the president of the Institute of Actuaries with a fairly difficult balancing act to juggle, to try to, first of all, properly understand what had gone wrong, but also be able to explain it to the media. There was a lot of media interest, and the sort of problem that was emerging became very political, because there were a large number of disabled people who had been relying on HH to for court-determined payouts and pensions that, of course, suddenly were not getting any money. So the issue became very political very quickly in Australia. I suppose the regulatory climate at the time was very important, and it wasn't nearly as strong as it should have been. And one of the major changes that arose from the insolvency of HH was a massive change in Australia's regulatory requirement around general insurance, and I can go into more detail about that in a minute. But possibly of considerable interest to people in this audience, at the time that HH collapsed, there were about 100 actuaries in Australia who responded to the Institute of Actuaries each year saying that general insurance or non-life insurance was their primary field of activity. 23 years later now, that number is about 1,200 actuaries. So the collapse of HH led to a tremendous growth in the need for actuaries in the general insurance industry in Australia.
So you mentioned that there was one actuary who sort of seemed to be in their pocket and wasn't perhaps doing what he should have. Was that a general theme through the organization, or did you feel this was a single actuary that just wasn't doing his job?
I think it'd be fair to say he was found by the Royal Commission to have not done a very good job, both technically and also in failing to make his views well understood by the executives of the company and the board. So let's just say he didn't come out of it very well, and he basically didn't practice again after this whole incident. The problem we had was to try to ensure that the actuarial profession was not tarnished by that. So we quite deliberately got on the front foot as a profession and explained actively our views about what had gone wrong and what were the solutions that needed to be put forward to fix that. And of course, they were whole of industry solutions, and the sort of things we're talking about there that emerged was, first of all, the role of a statutory appointed actuary for a general insurer in Australia was created, and that role was given teeth, including whistleblowing, and a requirement that they had to produce a report, not only a liability evaluation report, but also a financial condition report, which two separate reports, both of which had to go to the board and, importantly, to APRA, the regulator, who I have to say also didn't come out of this too well at the time, because they were found to have been a bit asleep at the wheel when a major general insurer just collapsed under the terms of the Royal Commission. So they were two major reforms. And then the other significant reforms that arose from it, which later I think it can be easily argued had quite international ramifications. There were major amendments made to the insurance accounting standard for general insurers in Australia at the time, and a new standard was issued. And for the first time, it required that a risk margin had to be included in the liabilities, and that wasn't good enough to just have a 50% probability of sufficiency in the liability calculations. In fact, it had to be a minimum of 75%. It also required that a risk-free discount rate had to be used to discount the liabilities to get an accurate figure of what they really should be. At the time, I think they were quite new requirements anywhere in the world for general insurance companies, but you can see a thread where now we have the relatively recently released International Accounting Standard for Insurance, IFRS 17, and both of those are features of that accounting standard. So I would argue there's been a progression over many years through Solvency II and some of the other regulatory changes there, where those ideas actually could easily be traced all the way back to the HIH insolvency.
Okay, thank you. Anything else you wanted to add on this particular case study?
Well, I think it's pretty clear that the whole culture of governance in Australia for regulations for regulation of general insurers changed. But what is interesting is that in 2018, 5 years ago, there was another major Royal Commission in Australia into the whole of the financial services industry, which included general insurance. And that also significantly increased a whole range of requirements around enterprise risk management and governance requirements. It would be fair to say, I think, that banks in Australia took the brunt of that, but the general insurers also found themselves faced with a new wave of general governance requirements that are now written into the law in Australia. So that whilst a lot of things arose from the HH disaster, for want of a better word, and they were very much governance related around lack of proper board governance and proper actions by the CEO, evidenced by the fact that the CEO wound up in jail. There was still plenty of scope for further development of the regulatory framework, particularly around enterprise risk management, which has now been put in place over the last 5 years or so. But I'll probably leave it at that for now.
Okay, thank you very much, Tony. So Masatoshi, I'd like to move on to you. You're going to speak about Toho Life and I guess a little bit
Yes.
about the general situation in Japan. I'll mention for the audience that Toho Life is not one of the cases that was included in the
Yeah.
chapter of the risk book. We did talk
Mhm.
about another Japanese company that I think had problems at about the same time, but
Yeah.
we'd like to hear a description of what went on at Toho from you.
Yes. Thank you. My name is Masatoshi Edo, and I may go briefly go through about the Toho case. And Toho was the mid-sized company at the 1990 with about 40 billion dollars of asset side with 90 years of the history. And from 90, when I started my career, Toho has just become one of the top runner with regard to the bonus level. Toho was a mutual company, so all the products sold was par. And the management, I recall, described such situation as dreams come true. Then later, around the mid-90s, started to face financial difficulties. I may describe some of the reasons later. And the Toho started to seek sponsors to support the capital position, but conditions indicated were not at all acceptable for the management. So virtually gave up. And later, 1998, Toho entered alliance with GE Capital or GE Group, which include new business right transfer. So Toho needs to stop new business and transfer that sales right to the new company. And with the proceed of about $700 million at that FX rate in those days, which means Toho stopped new business. And also Toho sold in-force block, which is profitable, with getting about $500 million of the ceding commission, which means that the future profit was kind of cast at the moment. And in terms of the new business right of the $700 million, there was a clause that if the sales performance doesn't meet the initially set target, the discount be made about, say, 30% of such money. And also, Toho needed to inject the capital to the new company, which is almost offset the sales proceed of the new business right, which is a little bit tricky part of this deal. And however, which is about financing the capital of a new company, 50%. However, voting right was quite limited. So the injection of the capital to the new company was in the form of subordinated loans or some other form, but voting share was limited. The key factor was that Toho was selling quite high yielded individual annuity, and also to support such a high yield product, made a little bit dangerous investment activities, including the real estate, and which ended up deteriorating in the later years in conjunction with the financial crisis in Japan as a whole.
So from what you've described, would you say the primary factor leading to their problems was the investment side or the culture at the company or what?
Both.
Both.
And
Okay.
the investment activity is kind of, natural consequence of the management. And I needed to tell that, it would be surprising that mutual company is dominated by one single family in terms of the presidency. Presidency was inherited, several generations of the same family. And the management decision was, made in a very closed room of limited people. And the investment person or the executive was, there was no control.
So I think you mentioned to me earlier that there were other bankruptcy cases in Japan during the same period. So were there common aspects to those failures, or was each situation a little bit different?
I think that a lot of commonality among those companies, which is that, focusing on the high yielded, either individual annuity or some, asset heavy product. And I would say that there were 9 cases of failures happened in those days after mid 90s.
So do you think the regulatory climate in Japan at that time contributed to it, or did they help the situation get it resolved?
It's a cynical thing that I believe there are some companies already in quite difficult situation. However, bankruptcy procedure and or bailout rules were not set until late 90s. So maybe regulators couldn't force the liquidation and or bailout until the regulation was set.
Okay, so how about the role of actuaries in the whole situation?
I think it is very difficult. And in Toho case, it was the first case that appointed actually made a death sentence to the company, which means that appointed actually was supposed to make financial projection or analysis of the capital position to the future. And if the capital is not sufficient, he needs to write as such. However, as you know, appointed actuaries are employees. And making a strong note to the board of directors was not easy things to do. But so as such, although the laws request the appointed actuary to be independent, however, their position is just an employee. So that made quite difficult to accomplish the legally required things. And I heard many appointed actually faced a disciplinary action by the institute because immediately after they wrote the appropriateness opinion of the capital position, several companies failed. As such, that the analysis was not honest, something like that.
Okay. Anything else you wanted to add on this piece of what went on in Japan?
Okay, let me check. Oh, okay. So, some of the, bailout, money is that, in those days that the prepared money for bailout, for the industry was about $4 billion. And Toho used up everything. And the bailout structure kind of, corporation was set as an industry money invested. And later failure, such organization ended up borrowing money from bank to support other bankruptcy cases. And those bailout ends up the policy condition changes, and by reducing the future crediting rate and keeping the gross premium paid by the customer. So face amount decrease and the cash value growth is limited. Those kind of burden was forced to the policyholders.
Okay, thank you.
Okay.
It's very interesting.
Yes.
Let's turn on to Stuart now, who's going to talk about Confederation life in Canada. And Stuart, sort of the same thing. Could you start out with a short description of what the issues were at Confederation?
Sure. Thanks, Kathy. Well, Confederation Life Insurance Company, or Confed for short, was a Canadian mutual life insurance company founded in 1871. It was the fourth largest Canadian insurance company at the time of its insolvency in 1994. It was a financial conglomerate with operations in Canada, the US, the UK, and Bermuda. And at the time of its wind up, it had assets of about $19.4 billion. Pat Burns was Confed's CEO from 1985 till 1990, when he was also chosen to be chair of the board, in addition to his titles of president and CEO. He drove a rapid expansion policy to expand the company's size and operations. He focused the expansion on asset growth, not the traditional insurance strategy of liability-driven growth with matching assets. Confed increased the sales of new business by crediting high interest rates and high non-forfeiture benefits when compared to its competitors. It generated these higher rates by investing in real estate, including mortgages. While other peer companies also were adjusting their growth towards annuities and universal life products in this period, Confed's drive for growth was unusually aggressive. By October 1989, 74% of Confed's assets were in real estate and mortgage loans, much higher than their peer companies, and of course, much higher than the Canadian regulator OSFI was comfortable with. But the true test of Confed's real estate deals arrived in 1990 as a recession came to Canada and to the UK. As loan losses rose, Confed's liquidity and surplus levels were eroded significantly. In late 1992, under pressure from OSFI, Pat Burns was replaced as CEO by an outsider, Paul Cantor. An urgent search for additional capital began in 1993. All options were on the table, including demutualization or a sale of some or all of Confed to a competitor. All the major insurers in Canada were involved, including some from the US as well. But Great-West Life was the leading candidate and performed most due diligence. However, the more they kept on digging, the more problems they found. Eventually, time ran out on August 11th, 1994, and the Department of Finance authorized OSFI and COMPCOR, the Canadian Policyholder Protection Organization, to take control of Confed. In his 1996 book, Who Killed Confederation Life, author Rod McQueen estimated the potential losses at that time to be $2.6 billion.
So that's a lot of stuff that went on there. Can you kind of isolate what you think was the primary factor driving the problems?
Sure. Well, Confed's biggest problem, as you can perhaps tell from my first summary, was its focus on asset growth in the 1980s, which resulted in excessive concentrations in real estate and commercial mortgages. As I mentioned, by the time Confed got to 1989, its exposure was up to 74% of total assets, and peer companies in Canada held far less. But many of the deals that Confed conducted were very large commercial developments, mostly in retail or office developments in Canada and in the US. In the US, the developments were really just concentrated in only 5 states. As one observer put it, Confed was eager to approve most deals in sight. Confed also built in this period 3 new corporate offices for its staff in different countries, including a $90 million headquarters in Toronto, which was eventually completed in 1992. The 1990 recession in Canada and the UK began to trigger significant loan losses. But in addition, problem loans in the US alone amounted to more than 2/3 of the company's surplus. Such losses further eroded already thin levels of surplus. As one developer put it, Confed seemed to have a reverse Midas touch when it came to real estate. Everything was not turning to gold, but the opposite.
So you did talk some about the regulators getting involved, but overall, was the regulatory climate helpful in addressing the situation, or do you think it contributed to the problems?
Yes, well, my quick answer is that the regulators really took too long to stop the bleeding. The Confed group of companies was supervised, of course, by a variety of supervisors globally. As the head office of Confed was in Toronto, Canada, OSFI, Canada's federal regulator for banks and insurance companies, was Confed's home or lead supervisor. As such, OSFI was responsible for the solvency of Confed's worldwide business. Naturally, Confed's insurance operations in other jurisdictions were also supervised there by their local insurance supervisors, such as the NAIC in the United States. And of course, Michigan was the lead state supervisor there because Michigan was Confed's state of entry. During the 1980s, Michael McKenzie, the superintendent of OSFI, knew that he had insufficient staff to adequately supervise banks and insurers, especially to conduct on-site supervisions. As a result, he was reliant on information provided by companies, from the auditors, and from industry gossip. In this period, the relationships between companies and OSFI were frequently adversarial. The boards typically sided with their management teams and rarely conducted their own independent reviews of management. Indeed, the relationship between Pat Burns and Michael McKenzie were very frosty. As Confed's real estate exposure grew, many of Confed's supervisors became concerned. McKenzie spoke to Confed's board in 1989, but with little effect. On October 25th, 1991, McKenzie presented OSFI's findings and concerns to Confed's board and senior management. These included Confed's insufficient capital levels, its deteriorating asset quality in real estate, and lastly, and perhaps most damningly, weak management oversight. After McKenzie's appearance, Burns assured the board that everything was okay and that OSFI's concerns were really due to the personal animosity between himself and McKenzie. As Confed's troubles continued, McKenzie increased his pressure on Burns and the board, eventually forcing the board to replace Burns in late '92. As the search for additional capital began with Confed's new CEO, Paul Cantor, the extent of Confed's problems kept growing. Increasingly, Canada's Department of Finance was brought into the gloomy picture of OSFI.
Okay, so the same question I posed to our other panelists, in terms of the role of actuaries in all of this, where were they, and were they being effective or not effective?
Well, let me just give some background and get to the punchlines later on in just a minute. Confed employed a number of actuaries, as many insurers did, throughout its operations globally. Mike Rosenfelder was the chief actuary based in Toronto. His actuarial team was responsible for valuing the global policyholder obligations in accordance with relevant regulatory requirements. In 1992, and this next sentence or two is important for context for readers unfamiliar with the Canadian scene. But in 1992, the Canadian Insurance Companies Act was modernized with significant responsibility placed on the appointed actuary of an insurer to prepare a future financial condition report for the board and to report to OSFI any concerns. Also, the valuation of policy liabilities was changed to a gross premium valuation method, which used a combination of best estimate assumptions and margins for adverse deviation. Such valuations required the use of considerable professional judgment by the actuary, all bounded by professional standards, I must add. Along with these changes, OSFI introduced new minimum continuing capital and surplus requirements, and companies were required to maintain those capital ratios of at least 120%. So as Confed entered 1992, there was very likely considerable pressure on Rosenfelder as the chief actuary to fine-tune his liabilities. But in retrospect, Rosenfelder had little room to maneuver, as his margins were only a fraction of those held by his peer companies. And I should probably add a personal note here that I was the actuary hired by the liquidator in the case of Confed. Further, it was found that Confed's massive annuity portfolio was being valued using the assumption that it was well matched, when in fact it was only duration matched and required a significant repo position to maintain it. Rosenfelder maintained the use of his approximate method despite a new CIA standard for annuities that required scenario testing to capture the mismatch risk. Despite the worsening picture of US and Canadian real estate and mortgage losses, Rosenfelder had not modeled the potential for future loan losses and the need for additional provisions for them in the policy liabilities. The combined shortfall in liabilities relative to its peers was many hundreds of millions. It was therefore troubling to OSFI when it received Rosenfelder's very first future financial condition report in 1992 that it consisted of just one page, and it reported a satisfactory condition. This despite early MCCSR returns showing a ratio of 125%, barely above OSFI's target and much lower than its peers. Michael McKenzie was quoted as saying, Rosenfelder was a nice guy, but there was a fundamental lack of independence from the operations side of Confed. Even a member of Confed's US management team admitted that he had a tough time getting answers from Rosenfelder's team, adding that Rosenfelder was, quote, not a great one to share what was going on. Many observers have tried to understand how Rosenfelder and his team could have been so offside of peer company practices. Confed's culture, though, was very insular, even aggressively so, and problems were rarely shared within the company. In the events subsequent to Confed's demise, the actions of the appointed actuary were reviewed. As a result, the appointed actuary was disciplined and removed as a member of the CIA. Back to you, Kathy.
Okay, I'll give you the chance I gave the others. Anything further you wanted to add on this? I know you gave us a very complete story.
Um, it- the only thing I would add to it is that even though the primary reason for its failure was the buildup of real estate and perhaps the way in which the real estate was concentrated and probably the way it was underwritten in the first place. But it was really the insular culture within the firm, the lack of really effective governance and risk management. That was you have to package those together.
Okay, thank you very much. Thank you to all of you. We're going to move on to some more general questions, but I did note that there are a couple comments that have come in on the Q&A that relate back to Tony's presentation on Australia. And I wanted to invite him if he would like to comment about it, if you want to sort of summarize the comments, Tony, and give any reactions, or if you'd like me to read them, I'll do that.
Oh, no, I'll seek to try and summarize them and comment. The first comment was noting that there were some other actuaries apart from David Slee, who was the principal sole practitioner actuary for HH, who were aware of issues at HH at the time. And I agree with the point made that it is extremely important that professionals need to be brave enough to come forward if they can see issues rather than just stand by. Unfortunately, there was indeed a within the profession, well-known situation where two actuaries who had some involvement with HH, I think one was actually an employee, wrote quite an extensive paper on the issue of a unnamed general insurance company in Australia, which was, in their view, seriously under-reserved, and the paper set out in quite a lot of detail why they thought that, and was, to many actuaries, quite compelling, I think is probably a good word. And that paper was actually presented at a specialised conference that was chaired by the chairman of APRA at the time. And the whole point, I think, of writing the paper was that they wanted to try to draw attention generally in the profession and to the regulator in particular about HIH's condition. Unfortunately, for obvious reasons, they couldn't actually name HIH in the paper, but it was blindingly obvious to anybody who knew anything about the industry that it had to be HIH because it was the only company that had that sort of liability profile in the industry. So somehow that paper, although it was well known at the time and became almost notorious later, once the Royal Commission started investigating and asking questions about, well, why didn't this have an impact? It did actually effectively, the matter did cost the chairman of APRA his job. Indeed, APRA, which at that time was only about 3 years old as a regulatory entity, was very seriously reformed as a result in its own governance, amongst other things. So it was a bit of a sad situation, really. People did try to bring it to the attention of the industry and the regulator, but nothing happened. The second comment there mentions that the writer was a whistleblower who went to APRA and others about 18 months before the collapse. I don't know the exact circumstances of this particular issue, but that doesn't entirely surprise me. It was well-known people were trying to draw APRA's attention to the problem and didn't seem to manage to get their attention. And it also refers to another matter that I didn't mention. Although I still think the main problem at HH was straightforward under-reserving. Well, not straightforward, but it was serious under-reserving. And you have to understand here, an insurance company obviously charges its premiums in advance of going on risk. It gets all the cash up front and then, eventually pays the claims down the track. HH actually ran out of cash. So it's pretty hard to do when you're getting all your premiums paid up front. But anyway, that was the extent of their problems. But there were also some quite serious problems with accounting for reinsurance policies, which this second comment also refers to, which essentially allowed HH to delay the inevitable. And one of the subsidiaries they took over, FAI, was also doing similar things, where essentially profits could be reported, which were at best illusory, I should say. And the auditors, which at the time was Arthur Anderson, signed off on that, which obviously didn't help matters either. I would argue very much under the influence of the dominant CEO, but they were obviously contributing factors to the whole problem. It's worth noting, of course, Arthur Anderson at that time, I think within about 6 months of that episode, also signed off on the accounts of Enron, and of course now no longer exists as an audit firm. So it was certainly it didn't help their case, some of the things that they did with HH in Australia. The other thing that also did happen at HH, which is of interest to actuaries, well, more technically, it actually happened at FAI, which became a subsidiary of HIH. But there was also, and this also emerged in the Royal Commission, but there was an instance where one actuary, it would be fair to say, I think, knowingly gave an external actuary for purposes of valuation, not David Slee. It was actually an actuary at the firm that became PricewaterhouseCoopers, and gave him data which basically excluded some of the, simply left out data which related to some of the large liability claims, so that when that actuary produced his valuation, of course, he wound up with an underestimate of the claims for the simple reason he didn't have all the data. And that was another part of the under-reserving, which came out in the Royal Commission.
Okay,
so
thank
my
you.
comments at that point in the interest of time. But as you can probably see, HH became a fairly celebrated financial disaster for a whole series of.
Okay, thanks. Appreciate that, Tony. We can go on to the next slide. We have a couple more questions in the chat, but we also, I think, are going to touch on some of them with a more general discussion that we were planning to have. All of these case studies that we looked at occurred a number of years ago, and I think a lot of us are interested, including some of the people asking questions, in, have things changed? The current ERM environment in each country in terms of both regulation and risk culture. Do we think there's been an improvement? Could the same things that happened before happen now? So is there anybody who would like to take a shot at their views on that? Okay,
Yeah.
Stuart, sure.
Oh, comment as well, but you, Stuart, go first.
Okay, well, let Stuart go first.
Yes, well, I saw the third question that came up in the chat as well. So I was just going to say, from in the Canadian environment, my experience has been OSFI certainly did take significant actions post Confed in order to strengthen their supervisory framework. They also staffed up considerably, including actuaries and other technical specialists necessary to do proper on-site examinations of insurance companies. And many of the actuaries that they hired, that OSFI hired, were those with industry experience. I guess I'm an example of one of those that OSFI hired in the end to beef up their practices. And yes, OSFI has produced a number of, we call them guidelines, but we'll call them regulations for the purpose of this call. We prefer the term guidelines, but they have about the same strength. And among those guidelines were those on governance and risk management, stress testing, things of that sort. So as the questioner in question 3 actually brought forward, I'm not surprised this has happened in a number of jurisdictions. However, the one thing with my OSFI and my Canadian experience, in the back of my mind as I talk about all these improvements over the years, OSFI was always guarding against the fact that as soon as it produced a guideline and published it and had it up on their website, we were always worried that insurers would respond with compliance. And what I mean by that is, okay, compliance is good, yes, but were they really, or were insurers really taking the issues to heart, or were they ticking off the boxes basically and saying, oh, here's the new guideline, tick, 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 I've done it, okay, now I'll get back to what I was doing. And so I think that that's more the concern from a regulatory or supervisory perspective. Our company's really taking these the intent of the guidelines or regulations to heart, and so I think that's the issue, and that will always be the issue, I think, going forwards.
Okay, thank you. Masatoshi, I'll come to you next. Do you want to comment?
Yes, several things that, as compared to those days, that in those days, there was no SOX, right? So also, which means that, and also that the technique or the attitude of the auditors has all changed. For example, in those days that the auditors allowed to do the advisory at the same time. So there is a conflict of interest. Those things are not removed. So the current environment of detecting those issues before it becomes really a failure is much, much improved. However, I don't guarantee it never happens. Still, people can come up with a new idea of hiding issues. But it is also that there is a lot of improvement in terms of the ethical standard or the regulatory requirement. They don't just look at check. Rather, making a conversation with management and appointed actuaries more as far as Japan's case. So which is similar in many places, I believe. But again, that we always need to pay attention about new technique. Yes.
Okay, thank you. Tony, I think you maybe had something to add too.
Yes, I guess I'd just like to reflect a little bit on more recent experience in Australia in answering that question. I mentioned earlier some of the important changes that have been made, particularly in general insurance and the role of the appointed actuary and the accounting standards, and that flowed through in Australia to both health insurance and medical indemnity insurance. But it's remarkable how when you tighten the rules and the regulations in one place, somehow, somewhere, somebody else manages to find another way of making a mess of things. The example I would give at the moment is much more recent, but in the early 2020s, the life insurance industry in Australia basically got itself into a fairly serious mess. And I think from memory, the financial year 22 in Australia, the life insurance industry managed to lose more than 1 billion Australian dollars in a single year. And the reason essentially was that disability insurance, particularly income disability insurance as a market, got pretty much out of control. And APRA, to their credit, were well aware of this problem and actually imposed some very large specific capital requirements on individual companies. And by very large, we're talking hundreds of millions of dollars of additional capital that they required those companies to hold until that they had taken various actions that APRA deemed to be necessary to essentially straighten out the mess that had been created, basically through a lot of competitive pressure in the marketplace, a rise in mental health claims in particular that probably weren't envisaged by the companies, but which certainly had become capable of being brought home to the policies after they were written. So I guess I just say that even though we had significantly improved regulatory standards, one of the contributing factors to that whole mess was actually an Australian accounting standard at the time for the life insurance industry, which was different to the accounting standard for the non-life industry, and which has now been fixed by being replaced by IFRS 17, I'm pleased to say. But it essentially allowed companies operating in the life insurance industry in Australia to hide losses that they were incurring on writing new business for disability income insurance, so that the losses only emerged much, much later than when they were really being incurred. And that was a critical failing of that standard, which wasn't really all that well recognised, but was effectively changed quite recently because of the adoption of IFRS 17. So I guess I mentioned that as a cautionary note that you might think you've got all the risks under control, but unless the culture of the companies is genuine, as Stuart was saying, not just compliance driven, there are certainly still ways for major problems to arise.
Okay, thank you. I'll kind of take it a little further in the direction of sort of the culture aspect, or having an ERM risk framework, which gets at some of the questions that were coming up in the Q&A. We've talked a lot about how regulatory has changed, but do you feel within companies there is more of a culture change, that they are looking at ERM as something that really helps them manage the company and the risks in the company, putting a specific framework in place? I don't know if any of you have seen any of that.
I'll take a short stab at that. I think over my career, particularly over the last 10 to 15 years, where I've mainly been a director of insurance companies, there's no doubt there's been a large amount of improvement in a lot of companies. However, there still are some companies which, or one in particular that I'm thinking of, where the culture wasn't what it should have been, and the end result was pretty unpleasant for that company. It's now a shadow of its former self. And I'm sure a few of the other Australians on the call can understand which company I'm probably talking about. But I think culture is still very important. And with all the best will in the world, with the frameworks for enterprise risk management that we're governance we've put in place, if the chairman and or CEO of the companies don't really believe in it, they will quite capably undermine it if they want to. And there have been some recent examples of that, I think.
Okay, thank you. Anybody else wish to comment?
Yes, I guess in my experience, the culture has come a long way on the risk management side. Unfortunately, there continue to be examples of risks that, how should we say, sort of pop out of nowhere, and people are surprised within the company, within the regulators, et cetera. And that's unfortunate. That's indeed one of the very tough tasks of ERM, is trying to watch out for the things that are coming over the horizon or you haven't yet seen, and try and sniff them out at an early stage. I know when the global financial crisis hit in North America, there were a number of companies, large companies, sprinkled through North America that were selling variable annuities and had not hedged them properly at that time, and they were caught, and they required significant strengthening of reserves and capital positions as a result. So those turned out to be quite sophisticated financial products that that maybe those companies were undertaking a bit too soon without that appropriate hedging in place. So that's a little bit ago now, that global financial crisis, but Who knows what the next one will be. Kathy, I was taking your question a little bit differently, if you don't mind, a little different direction, because the culture between regulators and companies is quite important to get it right. And I guess in my piece, my case study, I painted a picture of an adversarial relationship, not just between that one company and OSFI, but other companies in OSFI as well at that time. But I guess in my experience, that culture has changed quite significantly. And I think both sides, the industry and OSFI, have worked very hard in order to try and make sure they were dealing with issues before they became big ones, whether it be changes to capital requirements or improvements that need to be made in valuation because of problems that were popping up in a couple of cases. And so I think that culture of trying to discuss these issues in advance between the industry and OSFI it's gone a long way to get rid of some of that adversarial nature.
Okay, thank you. So we're about up at the time. There was one question that I found interesting. If any of you have a quick answer to it, we can maybe go a minute or two over. Is there any key takeaways from these case studies as actuaries that actuaries should learn from them or do differently to try and avoid having these situations come up? So if anybody'd like to take a quick crack at that, I don't want to keep our audience on too long.
I guess I would just say it's important for senior actuaries in particular to develop communication skills so that they try to get their message across, particularly when it's an important message to directors in particular of boards. Unfortunately, sometimes actuaries cannot necessarily communicate that well, or the communication is unduly complicated. And I think it's really important to be fairly direct and keep the message simple if you really want to have an impact and therefore have a chance of creating change. Obviously, there's always the fallback of trying to speak to the regulator, but as the HH experience showed, that sometimes didn't work too well. Anyway, I'll leave it at that.
Okay. Masatoshi, you wanted to say something?
Okay. I think that the risk management and so on is not about only the techniques or the rule settings and so on, rather more about the cultural saturation among the employees or management truly understand or digest those things. And I think that those things are well more and more well implemented, and those attitude by regulator is also looking at such an aspect rather than just checkbox approach, which I feel more and more advanced. But coming back to the lessons learned or the case studies that are we okay to continue having the appointed actuary as an employee? In many places like I think UK, the third party, appointed actually be, used. And I don't strongly push to, go that direction immediately. But I think some of the kind of, protection to the appointed actuary or actuaries be needed in such a case that they detect, but they cannot speak out.
Okay. Stuart, do you want the last word?
Yeah.
Well, I can't help but reflect back on Confed in answering this question. And in Confed's case, it was clear that many in the management team, including the actuarial team, were very insular in their approach. They thought they knew best. how to value risks and how to make provision for them, how much margins for uncertainty there should be, et cetera. And I think we have lots of examples that we've been talking about today, where it's very important in that senior role, at appointed actuary role, for the actuary to try and reach out in a number of different directions to make sure that their provisioning for risks is appropriate, and get different perspectives, even the regulator's perspective, as to where they think the industry is going and provisioning for certain types of risks. Talk to peer companies, that maybe even engage external consultants to try and give you a better sense of what's happening in the industry in terms of reserving levels, et cetera. So I think just attempting to get a wider perspective and not just accept one particular point of view as the way to go.
Okay, thank you. So I think we will close it with that. I want to thank the three panelists for an excellent job. We already, we've done the questions. The recording's going to be available in the next day or two. If you have further questions or comments, there's an email there. You can send them to the IAA Technical Activities Group. And you've got the email there, and they will pass them on if anything else comes in. I appreciate the participation from the audience. And again, a big thank you to the panelists. And we will close with that. Thank you.
Thank you.